Decentralized finance is a group of platforms and protocols that let us invest our own money without any banks in the middle taking all of our yields. So in this video, I'm going to explain exactly what decentralized finance is, what we can do on DeFi, what protocols and assets that we can actually use on these systems, and then how people actually go ahead and use DeFi to invest and make money without the bank in the middle taking all of their yield. I'll leave the timestamps for each section of this video in the description below, and some other videos and resources that I mentioned in this video will also be linked down there. The first thing we need to look at though is stablecoins, which are by far and away the most important aspect of DeFi. Stablecoins are just simply a cryptocurrency version of a fiat currency. You can have any fiat currency turned into a stablecoin, but obviously everyone's going to use the dollar as it is the world reserve currency. As you can come down and see the list of cryptocurrencies right here, you can see Tether and USD Coin are two stablecoins, and they're number 3 and 4 at the moment in the ranking. So they obviously have a very large circulation. If you come down as well, you can see Binance USD, another version of a US dollar stablecoin. A stablecoin, very simply, basically takes dollars and puts it in a bank in a one-for-one basis. So for every dollar that they have in a bank, they issue $1 of this cryptocurrency. So you can have BUSD or USDC or USDT. These are just different companies that are doing basically the same thing, which is putting dollars in a bank and then issuing on a one-for-one basis this stablecoin. Now, you may be asking, well, how decentralized is that? And the answer is not really, unfortunately, but that's the way it is. Just like everything in life, that most things are gray and not black and white. And so this is the best way you can get a trusted value of a dollar into the cryptocurrency space. Also, as well, really important to know is that not every cryptocurrency is created equal. Some cryptocurrencies are very trustworthy in terms of the assets that they hold in those banks, and some are less so. So what you'll usually find is that a cryptocurrency holds mostly cash, UST bills, which are very, very short dated debt. So you can call these kind of near cash instruments, and then a collection of other types of money market fund. The reason they do this is because all of these actually earn them a yield. So they can take our dollars, invest them in money market funds for maybe 2% average interest, and then pocket the difference. They're giving us a service though, so that's kind of, everyone's a winner. Now, if you come to something like Tether, they actually show you exactly what they hold in their bank in order to back the value of their stablecoin. I'm going to leave it there. It gets more complex, but essentially a stablecoin allows us to trade and transact, and it is the oil in the engine. Once you have digital assets, you can create money markets for those assets. That's where people that have assets can lend them out for an interest, and people that need to borrow them can do so and pay that interest. So this is exactly what happens with a bank. You have a borrower down here who wants to borrow a set amount of dollars to buy an asset. So he has this asset right here, and he goes to the bank, and they obviously give him an amount of dollars back to him in order to buy the house. Now, the house is the collateral because in Europe anyway, essentially if you can't pay back the loan, then the bank just takes the house. That's their collateral that they use to lend you the money. This is obviously a lender down here, and what he does is put his money in the bank to save it, right? So if you're a saver, you put that money in the bank, and that's the circle of life. Now, the issue here is that this horrible institution in the middle is taking a vig from each side. You basically get absolutely nothing for saving your money. And of course, the bank is charging people 5% as an interest rate to borrow money. They're sitting in the middle and they're taking 5% and giving nothing back to the saver. This is how cryptocurrency changes this. So you have a lender and you have a borrower as always. Instead of a house being in the middle, you actually have Bitcoin. Bitcoin, of course, is known as a store of value asset. It has a value. It's very large and it's a very liquid market, making it a very good asset to collateralize. That is, if you own some, you can use it as collateral to borrow against. So what you do is you go to the institution, in this case, not this horrible bank, but Aave, I'm using them as an example, which is an application that enables lenders and borrowers to meet. And then as a borrower, you can put your asset on the platform and obviously borrow those US dollars, and you can use those US dollars for any reason you want, and you're going to pay an interest rate, let's say 2% right here. So Aave, essentially, unlike a bank, don't take the whole profit. So as a lender, what you do is put your USDC or your US dollars on the platform, and you actually get almost all of what you lend out. So the borrower is going to pay 2% as an interest rate. Now, Aave are going to take about 10% of the 2%. So they're going to take a very small amount, and the vast majority actually goes straight back to us as the lender. So Aave is taking a much smaller amount only from the borrower when they borrow. The rest of it is going straight back to you. And you can see that here. You can see the supply APYs. So we can see exactly if you have dollars like Binance US dollar, you can actually get a couple of % interest rate through Aave from borrowers, and Aave is taking a very small amount. Now, just to kind of compare decentralized finance with centralized finance here, it's gray and not black and white, but essentially on something like Aave, for US dollars, if you want to lend them out, you're going to be getting around 2 to 2.5%. That also works for other platforms like Trader Joe, which is a similar platform, about 2.5%. If you go the centralized route and you actually put your money on platforms like Celsius and Nexo, they're actually going to give you way more. So they can lend out the assets to traders in a different way. So it's very different to decentralized finance, where things have to be a lot kind of less risky, and it has to be kind of downplayed a little bit. But on centralized finance, they can lend your assets out to traders and actually pay kind of just a higher yield overall. And so if you do want to put your crypto assets on these centralized platforms, you get customer service and you do get better rates overall. I'll leave some links to those in the description because they do have sign-up offers where they give you an amount of Bitcoin if you make a deposit. So check those links out below. So if we hold digital assets and we lend and borrow those assets, we can also trade them amongst other market participants as well if we want to swap from one to the other. So we can use a decentralized exchange. A decentralized exchange isn't that decentralized, to be honest. Decentralized exchanges are more about permissionless access rather than being fundamentally decentralized in their nature, at least as of making this video. But we can permissionlessly access these DEXs and swap the tokens that we have. So just like a centralized exchange, you will see one token that you want to sell. So that could be anything you want. And then you could swap that into any other token as long as it's supported on the exchange and also on the blockchain that you're using. Each blockchain will have its own decentralized exchange where you can swap one asset for another. And of course, this is an extremely important thing to do. On a DEX, you can swap coins, but really important with DeFi, and one of the massive points of decentralized finance is the ability for normal users to provide liquidity on the DEX. This is something that banks and institutions have done for hundreds of years, basically taking a VIG out of the market, taking trading fees, making money off of everything that happens in the financial markets. Now we can provide the liquidity ourselves and earn the trading fees of other people on these DEXs. So we can actually make passive income from these DEXs by providing our tokens as a service for other people to trade, and we keep custody of our tokens and we can take them back at any time. Now on a decentralized exchange, of course, like any exchange, you need to sell one token in order to buy another, just like any foreign exchange transaction. And so what you'll see is stablecoins being traded. You'll also see a platform token like Avalanche being traded against US dollars, or Ethereum being traded against many other coins. So you can trade and pay fees on here, but you can also put your coins on and earn some passive income. If you want to know more about how I use DeFi and DEXs to actually earn passive income, I have step-by-step guides on this in my crypto investor course, so I'll leave that in the description. It goes step-by-step through exactly what DEXs to use, how I use them, and you can actually see my portfolio and what I'm doing in real time in terms of earning passive income and where I'm actually putting those as well. So I'll leave that linked in the description. But what you really want to do is provide liquidity on these DEXs to earn that income. You actually earn better income from doing this than lending out your tokens for the most part. It does depend on which tokens you're using. But as you can see here, you can use a decentralized exchange like Curve and you get around 2 to 7%. If you want to use the Avalanche blockchain and use a decentralized exchange like Trader Joe, you can get anywhere from 2 to 50%, which is crazy. And on Binance Smart Chain, you can use a DEX like PancakeSwap and get around 2 to 50%. Really important though, is that this can become quite complex and some assets are much riskier than others, and there is something called impermanent loss. I go over this in my crypto course. I would very much suggest you understand the risks of this before getting involved. And I do have another video on DEXs for free that I'll link in the description that goes through what impermanent loss is and some of the considerations you need to go through before providing liquidity on DEXs. The next thing users can do though is choose which blockchain that they actually want to use. Think of each blockchain like a collection of market participants. Just like a bank has certain customers and certain banks have different types of customers, so does each blockchain. It's a financial ecosystem with its own liquidity, and so you can choose it based on what outcome you actually want. So for example, on Ethereum is one of the most decentralized chains and it has very secure block space. Because the block space is seen as more secure, it's more expensive to transact on there. Now, if you're a big whale, these fees don't bother you, and so you're probably going to use Ethereum. Ethereum is where most of the liquidity and trade is, and so if you're a whale, that's really important for you. So you can use a decentralized exchange like Curve Finance, or you can use a lending protocol like Aave. Ethereum also has layer 2 networks, which inherit most of the security of Ethereum, but lower fees. Even though these are layer 2 networks on Ethereum, like ZK Sync right here and Arbitrum, they are completely separate networks with their own separate liquidity. So you don't share the liquidity between the Ethereum base layer and the layer 2 networks. Each network has its own pool of liquidity. Now, you can obviously trade from one network to another, but liquidity pools do stack up on each network. So check which network is actually giving the most liquidity and the best yields at any given time. On Binance Smart Chain, mostly PancakeSwap is the biggest DEX, and you have Venus right here, which is the lending protocol. Each and every blockchain essentially will have its own main DEX and own main lending protocol. On the Avalanche chain, that is Trader Joe, and on Cardano, you have a bunch of them like SundaySwap and Wing Riders right here. But each blockchain will give you an option to add liquidity to a DEX, but liquidity is king as an investor. When you're an investor, especially putting your own liquidity on lending protocols or DEXs, you're really looking for the best yields. And so with a DEX, you're looking for the most trade. So you want to go to the biggest, best, most robust decentralized exchange that has the most traders and most people on there, because that's just more trustworthy and you'll be getting more fees overall. Trading volume is really important. So when you're looking at decentralized exchanges, look for the most liquidity and the trading volume. Overall, over the long term, you're going to get a better experience. And of course, low fees is really important for most people, because if you're not a whale, trading around millions of dollars, trading fees can eat away at a lot of the investment yields that you get. So low fees are important, and trustworthy blockchains and tokens is a must. Keep to the best, highest quality blockchains, and then you're not going to run foul of any kind of rug pulls or anything like that. Just like in traditional finance, in DeFi, there are also service providers and applications that build products that make our lives easier. An example of this is a yield optimizer or a yield aggregator like BNB Finance or Yearn Finance, and there are others as well. But what these do essentially is just aggregate all of the yields from DeFi and show us them all in one platform so that we can have an easier life. So for example, BNB Finance right here, you can see them, all of the yields across all these different chains: BNB Chain, Avalanche, Polygon, Arbitrum, Moonriver, Kronos Chain, and you can go down and see all of the different yields for all of the different assets. So if you know what you want to invest in, for example, stablecoins right here, you can see all of the best yields and you can decide which one to go for. So for example, if I want to invest DAI, I can get around a 53% yield right now, which is pretty crazy on the Phantom blockchain on the platform, which is the Scream. Now, do you want to do that? Well, you may want to go for a different chain, for example, something a little bit higher up the rankings that is potentially a little bit more trustworthy. So you can come down here and choose something like Polygon and QuickSwap, which is a bit more well known. Obviously, that's just going to aggregate the yields for you, and you have to do your own due diligence here, but it takes your USDC, it will find which chain has the best yields, and then go ahead and put them on the best DEX, which has the best yields. So to recap, what is decentralized finance? Well, it is actual finance and economics in a digital world, disintermediating these horrible lot right here. So you have money like a store of value, Bitcoin, or an investment like an altcoin, or actual dollars like a stablecoin. You have platforms that enable the rules to be set. Smart contracts are fixed in code and cannot be changed on these platforms. And that enables applications to be built to allow us to trade with other people in a trusted way without having to trust the bank in the middle. And then you have service providers which make everyone's life easier. So if you want to know how I actually invest in DeFi and make passive income with crypto, I'll leave my crypto course in the description. It goes step by step through actually getting involved in the chain, how to use wallets, how to think about assets, and how to put a portfolio together to actually earn some passive income. Other helpful videos I will list down in the description as well. I'm James with MoneyCG. Cheers for watching, and I'll see you in the next one.